to move from a resilient to a natural brilliant state.
We're all here to move our Black communities forward.
We think our children have to have the best. It's all about discipline.
How are we going to discipline ourselves so that we're able to save, so that we're able to make good financial decisions?
Recognizing that there's a road ahead if you manage the road in front of you.
The decisions that you're going to be making today in your lives where it comes to money will affect you in the future.
Discipline is one of the things that we often learn, sometimes by our environment, or sometimes we're forced to do it, and sometimes we don't learn it at all.
Stores want to get us in and out and get our money, and that's it. It's a game, so you have to be really wise to the game.
Do you know what it costs to run your home on a monthly basis?
Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Scéniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
This webinar provides illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Black Business and Professional Association. The BBPA makes no representations, warranties, or guarantees as to assume no responsibility for the content or application of the material contained herein, and especially disclaim all liability for any damages arising out of the use or reference to or lines on such material.
Good morning, and it is a beautiful Saturday morning here in Toronto. It's raining, but it is a beautiful Saturday morning. And we are encouraging you all right now to tell a friend to join us. It's not too late to meet us here on Community Space, the financial literacy program that speaks the language of the community. There's a saying, it's from somebody anonymous, that the best things in life are free, but sooner or later, the government will find a way to tax them. And right now it is tax season. So we all are just scurrying together to get all of our information put together. And also Albert Einstein, regarded as one of the most intelligent people in the world, said, the hardest thing in the world to do is to understand income tax. So we definitely know that It is a very confusing subject at sometimes, but to put it all together, it's something that we all have to do. But nonetheless, we are here with an expert today to let us know how to navigate some of that income tax world, but also how to invest in ourselves so that we're able to offset some of the taxes that or some of the income that we may have. So, ladies and gentlemen, it's great to be here with you, and I'd like to introduce to you again, second time here on Community Space, Mr. Ken Green. Good morning, Ken.
All right, good morning, good morning. Thank you for that warm introduction. And thank you to the BBPA for organizing this community space and for investing so much into our community. So I'm gonna share my screen here and then we can get started.
Okay, why are you sharing screen? How are you this morning?
Yeah, I'm doing well, I'm doing well. It's a busy time of the year, but you know, that's what we get to deal with every year. And we
Absolutely, this is the an accountant's favorite time of year.
That's right, that's right. That's what it is.
Absolutely.
Okay, so just let me know if you can see my screen.
Yep, we can see you
Check it out.
and your screen. And for those of you who don't know, if you could just let them know a little bit about what you do, and we can see your credentials here, but
That's right.
for those people who don't know what a CPA, CA, MBA is,
That's right.
Yeah, what do you do,
Okay,
Ken?
all right, I'll talk a little bit about that. I'll share a little bit about myself for those that don't know who I am. So CPA means Chartered Professional Accountant, CA, Chartered Accountant, all one and the same thing. Then MBA, I guess most people know what MBA is, Master of Business Administration. I'll share my story here very quickly. Immigrated to this country in 2002, and in the very cold winter in January, Saskatoon. So some of you may not know where Saskatoon is in the middle of nowhere, but lovely, lovely small town where we started our journey here in Canada. Left there, I went to school here, came back to Toronto in 2003 to pursue my MBA at York University, and then got lucky to join PricewaterhouseCoopers, and then started my journey there as a chartered accountant. And so that's where I qualified. I worked with them for about four and a half years, working in Toronto, working in the office in Los Angeles and San Francisco. And then coming back, I got so tired and I left and I went into financial services. So I worked in BMO, RBC, Scotia for a number of years. And in 2016, that's when I left. Started my business originally on a part-time basis, combining it with my work at the bank at the time. And then in 2012, and that's when I got together with my now business partner, Celia, who we used to work together in Pricewaterhouse a couple of years ago. And so we started GMS Professional Corporation in Mississauga. And so we serve individuals, we serve business owners and corporations, and we do a lot of work in the community as well, serving a lot of not-for-profit organizations, churches, and mostly in our community. And so my business partner, Celia, leads that practice, providing all the assurance services that all these organizations need for funding purposes. As I mentioned earlier, transitioning full-time into the business. And in 2020, I wrote the book, Tax Efficient Wealth. I'm going to be sharing a little bit about that today. And also started a community that we call the Tax Efficient Wealth Membership Group. And again, it's a community of like-minded people that actually take some of the tips I'm going to be sharing today, and what we do in the community, we take that and we make it real in our lives. And so it's an awesome community. We're just rebranding and we're launching it very early next month. So that's a little bit about me. Before I start, I always like to start with this important question. Why does it really matter? Why are we here today? So it's always an important question to start with, because I mean, you guys are taking your time out of your I would imagine very busy schedule to spend some time here to talk about taxes. Taxes is not a fun topic. Most people don't like to talk about it. It's probably the last thing that comes to mind for most individuals. But what people don't understand is that taxes is likely your biggest expense. And so if I ask any of you, what do you think your biggest expense is? I guess most of you will say, oh, it's housing, it's food, it's taking care of the family. And I can understand why with inflation. But by the time you start thinking about, particularly if you're working in this country, maybe you have high income, you're making over 100 grand, 200 grand per year as an employee, you begin to realize very quickly how big or how much you're paying in taxes. And most of us don't realize it. And the reason we don't realize it is because it is deducted upfront, particularly if you're an employee. And so you don't get to see it. Because you don't get to see it, you don't really feel the impact as much. And on top of the taxes we pay on our income, we pay payroll taxes. We pay taxes on gas. We pay alcohol tax. We pay HST on most purchases that we make. So by the time you take all of this and add it together, you begin to realize that taxes, your total tax bill is like 30%, 40%, and in some cases, even 50% of your total income. So that is huge. And because of that, it now becomes a major obstacle to financial independence. No wonder a lot of people struggle. No wonder you make 100 grand today, you make 200 grand, and you still live paycheck to paycheck. No wonder most people never achieve financial independence. And it's just because of this reason. So it's always important to understand how to manage your taxes. It's good to pay taxes as a good citizen. It pays for a lot of stuff that we do. And so the conversation today is not about avoiding taxes. It's about making sure that you don't pay much more than you are legally required to pay. And one of the other reasons, again, is that $1 lost today in taxes is worth much more than $1, right? So some of us will look at it and say, okay, let me just pay that additional $1,000 in taxes today. But if you think about what that $1,000 can do for you 5 years down the road, 10 years down the road, you begin to realize that you're just not losing $1,000, but you're losing the potential that $1,000 can do for you down the road, right? And so that's why it's important to manage and minimize your taxes. And some of you already know this. It's not necessarily what you make that matters, it's what you keep, right? So I may be making $200,000 today from my employment, from work, but if I'm spending all of it, then it really doesn't make any sense. I'm not getting ahead, right? And so that's why it's important to protect as much dollars as we can, so that way we can put those dollars to work. So one of the things I didn't do last year, I think I highlighted some of the things that are new this year with personal taxes, but I just want to highlight a few of them because I think we may have missed some of them last time. So there is a first-time home buyer's amount. So a lot of you may be familiar with this. If you buy a home for the first time, in the past, you will get this 5,000 credits as a reduction of taxes that you've paid. Right, and I think last time I tried to explain the difference between a deduction and a credit when it comes to taxes. You use deduction to reduce your income to come to an amount that is now called the taxable income. And it is on that taxable income that the government applies a tax rate to determine how much you're owing. On the other hand, a credit is a $1-for-$1 reduction on the tax bill that you're owing. So let's say my taxable income after all the deduction is $100,000, and they apply the rate, let's say 30%, and the government says, okay, Ken, you're owing $30,000 in taxes. If I get a credit, in this case, let's say I get a credit of $5,000. Now my tax bill is no longer $30,000. Is now $25,000 because of that tax credit. So tax credit is a $1-for-$1 reduction on your tax bill. Tax deduction is what you take to reduce your gross income or your total income to what we call your taxable income before the rate is applied on that taxable income. So what the government has done with the first-time home buyers amount is now they've increased it from $5,000 to $10,000. But to get a credit, what the government does is they always apply this. I don't know how they arrived at the rates. Yeah, I think I know how they arrived at the rates, but they apply this rate of 15%. So now determine what that credit is. So now that credit is to be 750, but now that credit is 1,500. So if you're a first-time home buyer, you automatically get this $1,500 to use to reduce your tax bill. There is Ontario Staycation Tax Credit. Some of you may be aware of this, that this is something that Rob Ford introduced last year. So it is effective for the 2022 tax year. So you can claim up to 20% of eligible expenses when you spend or travel within the province. And that amount is, I think, is $1,000 for individuals and up to $2,000 for a family. Okay, that's a mistake. There shouldn't be 42. So up to $2,000 for a family. So that's something you can use and claim to reduce your taxable income. Let me see. I think there are a few others again. Then we have the climate action incentive. So this has been around for a couple of years now. But the change here is that instead of having this as a refundable credit when you file your tax return, now you'll be getting a check in the mail. So some of you may already have gotten a check in the mail. It started in July 2022, but the requirement here is that you have to file, right? So you have to file to get this credit. So that's why it's always important to file your tax return. Then there is this school supplies credit that was introduced in 2020 as a result of COVID. So what the government has done now, they've increased the percentage from 15% to 25%, up to $1,000 of eligible school supplies. And they've also expanded what can be included in that eligible expenses. So things like digital timers, anything you use to support homeschooling of kids, you can include it in this expenses. There is a first home savings account. So this is a new account that the government passed into law, and is going to be effective next month. So I think a lot of the banks are most likely going to be ready by next month to roll out these products. So this is something that is available to first-time home buyers as well. So this is a special account that sort of combines some of the features we have now of the RRSP and the TFSA together. So with this account, you have the ability to save up to $40,000, $8,000 per year. And once you save this amount, automatically you can deduct that amount against your income. And when you withdraw it, it is tax-free. When you withdraw it for the purpose of purchasing your home, it is tax-free, right? So that's the good thing about this account. You get a deduction for tax purposes. The fund grows tax-free. You also withdraw it tax-free, right? So it's such a huge benefit to have this account, particularly if you're a first-time home buyer. So I would encourage you, if you're a first-time home buyer, as soon as we get into next month, go to your bank, see if they have this account, open it, and immediately start contributing into it. We also have the disability tax credit. So there's been some expansion here now to include type 1 diabetes. And so this is good. And this is also retroactive to 2021. So for those that, whether you filed your 2021 taxes or not, you can always go back and file an amendment to get this credit. And then we have this zero emission vehicle credit. So if you buy a car, an electric vehicle, or a car that is sort of gas efficient, then you get the opportunity to claim this credit. And then the RRSPs and TFSAs, we're all familiar with this, but we'll see here the contribution limit is increasing. For the 2022 tax year, it's $29,210. and that is going up to about 30,780 for the 2023 tax year. The same thing with the TFSA account. So for those of you that are not familiar with the TFSA account, is this registered account that the government set up a few years ago, where you contribute with your after-tax dollars, but that money grows tax-free. In other words, you can withdraw it tax-free. And so if you've been contributing to this account, the limit is 81,500 as at 2022, and it's just gone up now to 88,000 in 2023. Then for those that invest in real estate, there's a new anti-flipping legislation that is now in law, right? And so this was proposed in the 2022 budget. And what this does is that they would deny the capital gains treatment as well as the principal residence exemption when you flip a property. And what that means is if you buy a property and you don't hold it for at least 1 year, then you're going to pay a full, what's it called? You pay taxes on the full gain. So with a property, if it's the principal residence, you know that your principal residence, you can sell it tax-free, right? So that's one of the benefits we get as Canadians, and that falls under the principal residence exemption. You own a house today, you live in it, is your primary residence. When you sell it 5 years down the road, 10 years down the road, you pay 0 taxes, right? So that's a huge tax benefit that we get as Canadians in this country. Now, what a lot of people have done in the past is that they will buy property. Given the history of what has happened to house prices over the last maybe 20 years or so in this country, a lot of people that are smart real estate investors, they will buy a house, they will live in it for maybe 6-7 months, they will sell it, they will claim their principal residence exemption, they pay no taxes, they move to another house. I personally have a real estate agent that moved like 20 times doing things like this, right? A lot of people didn't get away with it because CRA caught up with some of them, and now they have a huge tax bill to pay, right? So CRA has been enforcing some of this stuff. It was never legislated until now, right? And so now it is law. You need to hold a property for at least 1 year, because if you don't, you don't get the principal residence exemption. You don't even get the capital gains treatment. So for those of you that are not familiar with capital gains treatment, if you have real estate and it is a rental real estate and you hold it for a number of years, what will happen is when you sell the real estate assets, you don't pay taxes on your full gain, you pay taxes on half of the gain, which is what we call the taxable capital gains, right? So I buy a house for $100,000, I sell it for $200,000, my gain is $100,000. But because it's real estate that I'm holding for long term, I don't pay taxes on $100,000. I pay taxes on half of that, right? So that's why real estate asset now becomes a very good asset to hold when you want to minimize taxes. And I believe it's some of the things I shared. I may have shared that in the past. So there are different types of income, and all the different types of income attract different types of taxes, right? In terms of tax rates. So it's always good to plan around the type of income you earn as well.
Ken, just a quick question.
Yeah, go ahead.
In that regard, what would be the percentage of tax that you would pay on if you were holding real estate and selling it in that same regard? That the 50% that you're being taxed on, what's the percentage that you'd be?
Well, the percentage, if you own the real estate personally in your name and you end up selling it, let's say 5 years down the road, you don't include the full gain, you include half of it in your tax return.
Correct.
Now, the tax rate that's applied to that will depend on your personal marginal tax rate.
Okay.
Because in this country, our tax rate is based on our marginal income. So if you're earning, if you don't have any other source of income, and that gain or that taxable gain is only 50 grand, then you know your tax rate is going to be low, right? Maybe like less than 20% or thereabouts. But if you have 200 grand from your place of work and you add another 100 grand from the sale of your real estate, now you're going to be paying 50-something%, right?
Okay.
Because now you're at the top bracket.
Right.
So we have the luxury tax. This one came into effect in September 2022. So this is just targeted to the rich, for those that buy expensive cars, expensive aircraft. So now, all these people that are buying Teslas now, spending over 100 grand, 200 grand, they're going to be caught up in this tax. So now you'll be expected to pay 20% on any on the price SX in excess of this amount, right? If it's over $250,000 for boats, or over $100,000 if it's a car or aircraft. So this is another tax, luxury tax. It may not apply to everyone, but again, if you're buying expensive vehicles and expensive boats, you may be caught up in this new tax. Then there is this one that's been in the news lately now. It's called the underused housing tax. So this is something that was intentionally, initially targeted to foreign owners of real estate in Canada. Because some of you may have heard in the news that there are a lot of foreigners that own real estate here, and they just have all the doors locked. They're not renting it, they're not putting it in the market, they're not using it for anything. And so that was the intention of this law, to target those real estate investors. But when they drafted the legislature, it turned out that people that fell under this act is even much more broader, right? And so if you own real estate, depending on how you own the real estate, you may be caught up in this act. So this act is effective as of January 1st, 2022. It requires you to pay 1% tax on the value of the vacant house, and that tax is only required if you meet certain criteria where the house is considered vacant or underused. And this only applies to residential housing. It does not apply to commercial. It does not apply to multi-unit residential housing. So for example, if you own a property that has more than 4 units, then this act does not apply to you. So there's something called the excluded owners, right? So who is excluded from this act? If you are a Canadian citizen, if you're a permanent resident, and you don't own any property as a trustee or as a partner or as a joint venturer, then you're excluded. You're not required to file, you're not required to pay the taxes. But if you're not a Canadian, but if you're a Canadian citizen or permanent resident and you own a property as a trustee of a trust or as a partner in a partnership, or maybe even as a joint venturer in a joint venture, then you may be required to file this tax return. If you're a Canadian corporation that is not listed or publicly traded, I work with a lot of investors that invest using a corporation. So for us, we own properties using a corporation, so now we have to file. So if you have a corporation that is not publicly listed and you own rental properties in your corporation, you'll be required to file. If you're a non-citizen or a Canadian, or you're not a permanent resident and you own Canadian property, you have to file. If you're an outside corporation outside of Canada, you have to file. So the penalties are huge. Filing deadline is April 30th. Penalties of $5,000 for individuals, $10,000 for corporations. Then here I just highlighted some important dates to keep in mind as we go through the tax season. So if you're just filing your personal tax return, which the government calls T1, you'll be required to pay all your taxes April 30th and to also submit your filing, your return on April 30th as well. Again, it's important to file on time because if you don't, they start applying penalties and interest, and now CRA has increased all their rates for interest as well. If you are a sole proprietor, you own a business and you run a business in your name, now you include that business schedule in your personal tax return. You have to, again, file. You have to pay, if there are any taxes owing, you have to pay April 30th, but your filing deadline is sort of extended to June 15th. And oftentimes I get this question, well, if I have to file by June 15th, how do I know what I'm owing, right? Sometimes you may not know, but you may have an estimate. And so if you have an estimate, it makes sense to just take that estimate, make the payment. And then once you file, if there's an additional amount owing, you can pay. And then if you pay too much, you can ask for a refund. If you have HST related to your business, again, payment due date is April 30th and filing due date is June 15th. So I don't know if we need to pause for questions here before we dive into business expenses. Otherwise, I can just continue.
Folks, here's your opportunity to ask a tax expert some of the things that you may be pondering and that you may have experienced in the past, and maybe there's a different way to do it this year. So please do step up to the plate and ask your questions. So we have Amani. Good morning, Amani.
Good morning. Good morning. Yeah, thank you, Ken, for the presentation. Just a curious question. When you mentioned about the staycation tax, the vacation that you take within Ontario,
yeah,
when you claim them, I know it's a new legislation, but I'm curious to know if you have to carry over. Let's say you use vacation in 2023. And you're going to claim it in 2024. Is that allowable?
I don't think it may not be allowable. So remember, this is a temporary measure. And this is available for the 2022 year. I believe it may be available for 2023, but right now it's available for 2022. What this means is that you actually have to incur that expense in 2022 to claim it in your tax return for 2022 that you're going to be filing now.
And just in that same regard, Ken, what would be an eligible expense? Is it like a hotel, like, you know, or Airbnb or anything else where you can obviously prove that you spent money in the province?
That's right. So it's mostly going to be hotel. I'll look into that. I don't know if your travel cost is included, but it may be included. But there has to be a receipt, right? So for the most part, it's going to be accommodation expenses. It may be other additional expenses you spend in going to maybe a movie theater or watching a theater or going to a show while you are on vacation with your family members. Again, it has to be supported with receipts. So what the government has done, they've asked you to keep receipts, and they've actually specified what those receipts, what should be included in the receipts, right? And so if you go to, I think there's a lot of information on this if you go to either the Service Ontario website or the CRA website on what needs to be, what is an eligible expense and how you should maintain your receipts. So when you're filing your taxes, you're not required to submit your receipts. What the government will do is that I think they will randomly conduct audits, and so they may request that you submit some of your receipts to support or substantiate your expenses.
Any more questions, folks? Anything else that you would like to ask Mr. Ken Green in regards to your taxes? Usually, this is a paid service, folks, if you understand what I'm saying. So do ask these questions now. If you've got any questions about your personal income taxes or any of the things that you can offset, do ask them now. All right,
So
Ken.
maybe, maybe we can proceed then with the business expenses.
Okay.
And take it out from there. So when you're running a business, obviously there are lots and lots of benefits. When you're running a business, there are tax advantages. It gives you the ability to write off expenses. And we're going to go through some of those expenses shortly. It gives you the ability to leverage. In other words, you have the ability now to use other people's resources, to use other people's funds, money, time to run your business. It gives you the ability to generate income and to scale that income as you're running your business. It gives you the ability to run a lifestyle business, right? So you do a business that fits with your lifestyle, whether you want to work from home, whether you want to be working from Barbados, anywhere in the world, you enjoy that lifestyle when you run your business because now you can dictate what you want to do. It's also an opportunity to run and do what you love to do, right? So a lot of people have passions. They have passion outside of their day-to-day work, and so it may be an opportunity for you to ignite that passion. And sometimes what people don't realize is, even though it's a passion that you're not sure whether it's business or not, I think you have the opportunity to turn any passion you have into your business, right? And so you use that and you use it as a way to sort of manage your tax exposure. And you also have an ability to impact other people, right? And so that's the reason why some of us are passionate about a certain cause, passionate about certain things, because sometimes it may not just be because of the income or the money we need to generate or the wealth we need to create, but more importantly, it may be about the impact we create in our community, in those that we're going to be engaging with as part of this venture, right? And so these are some of the benefits you have when you run a business. Now with CRA, it's always important to ask yourself, CRA this is the question that they will always ask when you present them with a business statement, right, in your tax return. And the first question is this: are you really in business, right? And the reason why this question is important is because for those that understand how business works, if you run a business and you're making a loss from your business, oftentimes, if that business is run as a sole proprietorship business, you can use that loss to offset your income from employment or income from other sources. And by doing that, you're essentially reducing your tax bill. So because some people have this understanding, what they do is they find a passion, they find a hobby, and they claim that they're running a business, and they begin to do all these things, and they're incurring all these losses year after year, year after year. And then at some point, CRA will come and ask them, are you really in business? And so the test that CRA will often run is this test that we call reasonable expectation of profits. So in other words, when you're starting a business, do you have a reasonable expectation of generating a profit with that business? And when CRA runs this test, they go through some of these questions. So this is not a comprehensive list of the questions they go through, but these are just some of them that they go through, right? What is your profit and loss experience in the past years? Have you been running a business for the last 5, 10 years, where all you've done is just loss after loss, and the loss is growing? They look at that history, and then based on that history, they may reach a conclusion that says, no, this is not a business, this is a hobby. And then they go back after all those years and deny all those expenses, and now you have a huge tax bill to pay. They look at the length of time required to reasonably get to profitability. And they just don't look at your business in isolation, because CRA has all this data for different businesses in the country. They take your business and they compare it to other businesses in the same industry, in the same area, in the same city, right? And they look at all those businesses and say, okay, well, this is Ken Green here running an accounting business, but there are 10 other accounting businesses in Mississauga, and these businesses over the last 5 years, they've all been making profits. How come Ken Green has been reporting loss for the last 5 years? Because now with this data, they know that if you run an accounting business, it's okay, oh, maybe an accounting business, it takes like 2 to 3 years to get to a point where you become profitable. If you're growing trees, they know that maybe it takes 5 years for the tree to mature, to grow before you start cutting it down and selling it and doing paper. If you're growing vegetables, they know it only takes a season for vegetable to grow, right? So all of those things are things they look at. So they look at the time required to reasonably get to profits. They look at the extent of your business activity. So you just don't set up a business and you do nothing, and then expect CRA to consider that as a business when you're incurring losses. So they look at some of the things you've been doing. Have you been busy trying to learn something? What is your marketing activity like? What is your website like? What are you doing in the community? How are you learning to improve your skills? to educate your customers. What kind of services are you selling? What are the products you've actually manufactured and delivered in the marketplace? So they look at all these activities to see what you're actually doing. And they're looking at the time you're spending on these activities. They look at your qualification. Do you have the qualification and experience to run that business? What kind of training have you taken to run that business? They look at your intention. And the only way you communicate your intention is through a business plan. So they look at your intention. Okay, do you actually have a plan to run a business when you started? And they also look at the nature, the relevance, and the reasonability of your expenses. Again, they just don't look at your expenses in isolation. They take your business, they compare it to other businesses that are similar and operating in your area, right? So they have all the data, they do all of this stuff, and they run this test to determine whether you're actually in the business to generate profit in the first place. So always important to have this at the back of your mind when you're running your business, and make sure that you're putting in all the work, you're putting in all the activities, and you're doing everything that you can to see that you make that business work for you and for those that you're supporting. In terms of the eligible expenses, in general, when you're running a business, what you can expense anything that is relevant to generating income for that business, right? And so that is just the general overview. Any expenditure that is necessary to generate income for that business, it will be considered allowable business expenses. And here are just a couple of examples: advertising expenses, bad debts. Maybe you sell something to a customer, they go bankrupt, they're not able to pay you back. You can take all that invoice and expense it as a bad debt. Your business startup cost, right? You may spend money doing consulting. You may spend money paying a consultant to write a business plan for you. You may spend money building a website, renting a space. All of this money that you spend to get your business off the ground is something you can expense. So business taxes, if you work from home, you can expense a portion of your home expenses. Capital cost allowance is the depreciation you get on big items, like you buy a computer, you buy a property or an equipment to run your business. You don't expense that all at once initially, you expense it over a period of time. So that's what the capital cost allowance is. Or your delivery expenses, insurance, interest, legal fees, maintenance and repairs. If you're paying any management or admin fees, meals and entertainment. Meals and entertainment is only, it's only limited to 50% for the most part, so you don't expense the whole portion. If you have a vehicle that you use for your business, you can expense that. Property taxes if you own a building, rent, salary, supplies. So all of these expenses you can expense if you can demonstrate that they are relevant to the business you're running. Again, obviously, you have to keep supporting documents for these expenses, because oftentimes CRA can challenge some of these expenses and request that you provide documents. So receipts, evidence of payment, and all of those things, they may require you to provide them. So that's it about business. And now we can talk about some of the tax planning considerations. So with taxes, so right now we are planning and filing for taxes for 2022. So because we're already filing for 2022 that has already passed, you don't have a lot of room to make a lot of changes to what has already happened, right? So you don't have a lot of room to minimize your taxes. You don't have a lot of room to manage how much taxes you pay. That's why planning comes into play. That's why planning is important, because now you don't want to be in the same situation 1 year from now when you're filing your taxes for 2023. Because now you have time to plan. You have time to put things in place so that you're not paying or faced with a high tax bill. So how do you reduce your taxable income in 2023 and beyond? And one of the things I like is government has given us a couple of tools. And I always encourage Canadians to use these tools as much as they can in running their affairs, right? So if you have TFSA and you have some ability to contribute to it, I encourage you to contribute to it because that's money that grows tax-free, right? And contribute to it, use it as a long-term strategy, use it as a strategy to hold your emergency funds, as a strategy for retirement if you wish, as a strategy to save for a home, for a car purchase. Just use it and allow that income to grow tax-free. If you have RRSPs, contribute to it, particularly if you have high income. You get that immediate deduction to reduce your taxes today. Now with RRSP, you're not eliminating taxes. What you're doing, you're deferring taxes to a future date. And so I like the idea of strategically planning around how you withdraw from your RRSPs if you have them. So I encourage you to contribute into it, particularly if you have high income, to minimize your taxes today, and then plan on how you strategically withdraw from it so that you're not faced with a lot of tax bill at the time you're withdrawing from it. If you don't have a business, consider starting a side business because with a side business, you can convert a lot of the after-tax expenses you're paying today to before-tax expenses. In other words, you don't earn income, pay your taxes on that income, and then what is left is now what you use to pay all these expenses. But perhaps you can arrange your affairs in such a way that you earn the income, you will reduce that income with all these expenses, and then what is left, you now apply tax rate and pay tax on that. Because if you do that, your tax bill is not going to be here, it's going to be somewhere here, right? So you're reducing your taxes that way. And this is even relevant if you run a business, right? If you're employed full-time. You're employed full-time, maybe start a business on the side. And then once the business takes off, you move that business from your name and put it in a corporation, because corporation gets to pay 12% tax rates, unlike an individual that gets to pay up to 50% or more in taxes. So if you're an investor, where possible, if you have securities that have grown in value, you can always take those securities and just transfer them to charities that accept all these securities. And what they will do, they will give you a donation receipts for the value of your investments, even though those investments only cost you a fraction of what they are today, right? And so that's something to consider. And sometimes if you have these investments as well, you can even use it and transfer and contribute it to your RRSP and get a full deduction for the big value of those investments that you have. So these are some of the ideas to consider. I talked about home, right? In Canada, if you own a home, you can sell it tax-free. So that's why I highly, highly encourage every Canadian. If you don't own a home, I think that should be one of your primary goals, to try to get your own home. I know it is crazy expensive to buy, but get together with friends, get together with family members, take a loan from parents, from friends, from anybody that you can, and just get into this business of owning your own real estate. Because now you stay there, you live there, it becomes your primary residence, you can sell it tax-free. You can leverage it to buy additional properties. You can, you allow it to grow. So some of you that have real estate, you know what real estate has done over the last couple of years. Over the long term, you have that guaranteed growth with real estate. And the good thing is, because of the environment we live in, real estate is virtually the only asset that can outpace or at least match inflation, right? So your salary cannot do that. There are many things that cannot do that, but real estate is one of those assets that just moves along the same pace as inflation. So that's why it's important to own real estate. And so once you get your own, then you try to get into other additional real estate properties, because now you get into the business of managing and owning real estate. And now you can do write-offs, you can do additional leverage. It becomes a very tax efficient vehicle. Not just for the business write-offs, but also for the ability to pay taxes at the lower rates because of the capital gains we get with real estate. So highly encourage you to plan around that if you don't have any.
A quick question before you go to the next slide here, Ken.
Yeah.
So how does the CRA distinguish between your principal residence and a rental property? So if somebody's got a rental property, say, and then they're obviously they're building that property or investing in that property, how does the CRA distinguish again that between your the rental and your principal?
Well, your principal residence is going to be where you live, right? So that's going to be your primary home. And so that will have all your addresses for your driver's license. You have your address with CRA as they know your principal residence. Now, your rental property, now some people own more than one principal residence, right? So there are lots of people that own their regular home where they live in the city, but they also own a cottage, right? So for people like that, they have two principal residences. Now, if you sell one of them, the government will not allow you to sell both of them tax-free, right? So you have to do what we call election. So you have to elect which one to sell for tax-free, or elect how many years you want to sell. So there's some tax planning around that if you own more than one principal residence. But if you own a rental property, that is something you have to report to CRA, right? So CRA will not magically know. I mean, they know because they share a lot of information. If you own more than one or two properties, they have the data. They know it that you own more than one property. But now you have to now report it if you own a property for rental purposes, because now you're renting that property, someone is paying you rent, you're incurring all these expenses, you take all that information and you include in your personal tax return. And so when you do that, that's when CRA now officially sees it and they know that you have a rental property.
Right. So in that case, I mean, I guess it's more in depth, but for instance, would it be better to have a corporation in that regard, or if you're with somebody and investing in rental properties, or is it better to be a sole proprietor?
Well, rental properties, ultimately it comes down to your goal, right? So I think if you just want to buy one or two rental properties, I think it's okay to just hold those in your name, right? And if your goal is to take those properties and use it as part of your retirement. But now, if your goal is to say, okay, I want to transfer this additional 2 or 3 properties I want to buy, I want to be able to transfer it to my kids. If that is your goal, it's possible to still own it in your name, but it's even better if you own it in a trust or own it in a corporation. If you're looking to buy more and more properties, corporation will probably make more sense to own those properties, because now, if anything happens to you, you don't create what we call a taxable event. Because in this country, if you, let's say, unfortunately, you pass away today, and I own a principal residence, I also own a rental property. If I pass away, everything I own is going to be deemed sold by CRA. And so when you sell something, obviously you may have a gain, and then there's going to be a tax bill.
Mm-hmm.
So oftentimes you have maybe a couple of rental properties in your name, you pass, now you have this huge tax bill that you have to pay. Remember, the property has not been sold, but CRA has deemed it sold. Now your estate and your kids will now have to come up with the money to pay these taxes. So just imagine, if you don't plan properly, then the kids have no option but to sell those properties, right? Because now there is no cash from anywhere. So they are now forced to sell a property that has served you for many years, that continues to provide income for the generation or for the family. And now they're just killing that cow, right? And selling it because now they have to pay tax bill. And so that's why it takes some sort of planning in terms of how you own property. Maybe get insurance, maybe owning a corporation, so that, because corporation has its own life, right? Corporation continues to live. And so that you don't trigger taxable events even when you pass.
Okay.
But that's a good question. It's always important to consider how you own these assets.
Folks, if there's any questions, you could put them in the chat, or you can just raise your virtual hand and we will address those questions. Okay, it looks like we've got a question here, Ken.
Okay.
All right. So this person's asked about what if you have not filed corporation taxes for 2 years?
Well, if you've not filed for 2 years, then yeah, maybe you get around and try to file it as quickly as you can. Now, if it turns out that you have profits or taxes payable, then CRA will obviously assess your late filing penalty, and they will charge you interest for those taxes that you did not remit on time. So if you have a corporation, I will encourage you to file them as quickly as you can. Again, you don't have a lot of issues if it's a corporation that has been idle, or maybe you've not done anything with the corporation, you're still required to file, right? But in this case, you just file, you don't have any taxes to pay. And in most cases, you may not be liable for penalties or interest. But again, it's always good to file on time as quickly as you can.
All right. And I believe it was a question from the personal taxes when you were speaking about that. Somebody talked about child benefits. Is that a taxable, is that somewhere you can deduct that impacts your income? So like, I guess, RRSP or any of those child benefits. Can you claim that on as an expense?
That's right. So if you have children, there are a couple of things you can benefit from that, right? So if you have children, there is the check you get from the government, which is tied to income, right? So there's this Canadian child benefits payments that families get because of the children they have, but again, that is tied to income, to the family income. You can contribute to their RRSP, the Retired Education Savings Plan, where the government gives you, I believe it's $500 if you're able to contribute to the max every year. And I think there's a maximum that the government will match for that. So those are some of the benefits. If you pay childcare expenses, that is a deduction against your income, right? So oftentimes it's going to be deducted by the lower income spouse in the family. They can claim those expenses. Again, you need to get a receipt from that. It has to be an eligible expense for childcare expense. And so those are some of the deductions you can get when you have children.
Okay. Those are the questions for now. Thank you.
So now let's talk about other tax planning tips. Again, there are a couple of tax planning tips for employees. So oftentimes we work for organizations, but we oftentimes don't negotiate, right? And so there are lots and lots of things you can negotiate with your employer, or things you can do to manage your taxes. So there's this article that I have there, 7 ways on how to lower your taxes as an employee. And so I don't know if maybe I'll share this slide with you. You can share with the rest of the group here. So things like maybe even negotiating to work from home permanently, right? So that is a benefit. If you have some people work in an organization where the organization provides them with a car, sometimes there are additional taxable benefits that are included as part of that car benefits, but you can negotiate with the employee and say, okay, but there are things you can do to minimize that tax impact, right? So maybe use the car more for business, maybe negotiate with them to see, okay, can I even use my own car and get some reimbursement for that? If you're going to get a bonus, you can even defer or time the payments of your bonus, right? So that if you think your income is going to be high this year or low next year, you can do some things where you shift some of these payments from one period to the other to manage your taxes. And so there are a couple of things you can do as an employee to negotiate some of these your employment benefits so that you're not always paying taxes on everything, right? You can even negotiate with the employer. So okay, instead of you to pay me, let's say your employer is paying you $250,000 as salary. You know right off the bat that majority of that is going to the government. And you negotiate with the employer and say, okay, well, I know you're paying me $250. can you even reduce it to 230 or 200 and then set up a scholarship fund for something for my kids or something, right? And so employers can do a lot of these things where they set all those things up. And now when your kids are going to school, they can now take some of that money and fund them as a scholarship, right? And now that becomes income that you don't necessarily have to pay taxes on. So there are a lot of ideas and things you can do to negotiate your employment income. Now, if you, we discussed earlier that we have this marginal tax rate in Canada. So one of the things you have to do is to just keep your eye on that tax bracket and say, okay, what can I do to fall to the next lower bracket, right? And so if I have 100 grand, what can I do? What kind of expenses can I deduct? What can I do to manage my income so that I fall just below the next bracket? And I think if you start thinking about this and start considering those, you may have opportunities to reduce or minimize your taxes. So I think that is all I have. And then I'm just going to share briefly in terms of how I support others. So for those that are looking for someone to file their taxes, so that's what we do as a business. And so we have 3 different options we offer to all our clients. If you have a very basic tax need, then we can certainly file your tax return at 275 per tax return. And then maybe if your situation is a little bit more complex, you own a business, you own property, then maybe it makes sense for you to choose one of the other packages that we have, either the standard or premium package. And particularly if you have multiple people in your family that you're filing tax returns for. So that's a service we offer. And I think we sort of included a lot of benefits, particularly for the premium option. We include not just your taxes, but how do you plan going forward to make sure that you're minimizing your taxes and you're growing your wealth tax efficiently. So that's something we included in that package. As I mentioned earlier, I do have a community called Tax Efficient Wealth Membership Group. And so we have this membership group that is open to everyone, those that are interested. And it's a group of like-minded individuals like me and you, people that are looking to put all their tax dollars to work for them, right? So if you're looking for ways to minimize your taxes, if you're looking for ways to invest wisely, if you're looking for ways to increase your knowledge, then this is what we're building this community for, right? You have the opportunity to talk to others that are doing the same thing. Lots of people in the community investing in real estate, just like I do. Opportunity to work with others, opportunity to just learn and expand your horizon. And so we have different levels from the basic option, which is just $597 to come in, to the premium option where you get the opportunity to work one-on-one with someone like me or with another coach within the group. So this is something we are relaunching next month. And so for those of you that are interested, you can let me know. We obviously support corporations. And so if you own a corporation, we can support you not just with the compliance requirements, but how do you use your corporate vehicle to save? How do you use your corporate vehicle to grow your wealth and to do it tax efficiently? And as I mentioned earlier, I have this book that I published. And so I will drop this link in the chat if you want to go grab a free copy that you can read electronically. Again, this book just explains in basic terms what are some of the things I need to know? What are some of the obstacles that is preventing me from growing my wealth? Or what is the tax smart plan that I can use? And what are some of the tools? Some of those tools we'll review today. And then it just gives you a blueprint in terms of how you go about making that real and happen in your life. And I think it's just based on this basis that we use to encourage everyone in the community to continue to grow their wealth. And then these are other resources that I have. If you have some time, you can go and read these resources. I do publish a weekly newsletter where I share a lot of ideas from time to time. So for those that are interested in joining and getting that publication on a weekly basis, you can subscribe to that. I'll drop a link in the chat as well. Here's my contact information. If you want to get a hold of me, my email address and my phone. And that is my team. So I don't work alone. I work as part of a team. It just turns out that I'm the only ugly person in the team, but I'm being supported by some amazing ladies in the community here that helps us support our clients. And I think that is all I have. And I think at this point we can take questions.
All right, so we have a question here also, Ken. So regarding personal taxes, is there a minimum amount that is required for medical expense and charitable donations?
That's right. So charitable donation, there's really no minimum amount. So whatever you donate, you get some benefit from it. But for medical expenses, it's sort of tied to income. I don't remember the exact percentage, but it's tied to income. But oftentimes your medical expenses will need to be at least $2,000 to $3,000 before you get any benefit from that medical credit, right? Because it's tied to income. So if you only incur, let's say, less than $1,000 in medical expenses, you probably won't get anything, right? So it has to be a little bit significant to benefit from it.
Okay. And also another question. So if you're a renter, can you claim the rent on your taxes that you've paid? I guess on your personal taxes.
Well, that depends. So if you're running your business in your home, then you may be able to deduct some of your rent expenses. In the past, we used to have the ability to deduct rent or get a credit for rent. But all of that is gone away now. It may be just very limited in certain instances. But for the most part, you don't get anything from rent except you run a business from home. Then in that case, you may be able to deduct a portion of not just your rent, but all the other expenses that you incur to keep the home operational.
Okay. Field, bring the questions, people. Bring the questions. Okay, another question here from Sean. Can you claim the membership fee for your services? So I guess if you've I guess yeah, for your services. If you're becoming a member, is that something that you can claim as one of the fees on your taxes?
Yeah, certainly. I mean, you can claim it, but again, it has to be tied to your ability to generate income. So for example, let's say you join our tax efficient membership and you're using it as a way to learn, to educate yourself so that you can be more productive in your business and the way you serve your communities, then yes, you can deduct that. It has to be tied to some sort of income. But it's not something that you can do personally. Let's say you're just joining and you're joining because you want to understand taxes, you want to grow your wealth, but you really don't have a business, you don't have a rental, maybe a rental property, then yes, in that case, you may not be able to deduct it. But it has to be tied to business. So if you have some sort of business, yes, you can deduct it.
All right. Bring the questions, folks. Bring the questions. Okay. So when would you suggest that people, when it comes down to their personal taxes, start to put everything together? Because you know, I think there's either it's a stereotype or a reality that, you know, people just start at the last minute just to pull together everything, and then, you know, sometimes they may miss things. So when would you suggest that, you know, the tax preparation starts just for the average individual who's doing personal taxes?
Yes, I think that's a good point. So what I suggested the last time was to try to get organized. So for those of you that were here the last time, we run a survey every year. And one of the surveys is, what we ask is, okay, what are some of the biggest challenges when it comes to filing your personal tax return? And the number one in that list is always getting organized, right? So people are always challenged in terms of getting organized and putting all their documents together to get ready for taxes. And it's not surprising because even me, that I'm a tax professional, I fall into that trap as well, right? So oftentimes my tax return is the last one to be filed. In the past, sometimes I may go for a year, sometimes two, without even filing my tax return because I'm busy filing everybody else. But if you get organized, and one of the easiest way to get organized is you do it all through the year, right? So as you get all those documents, and what I will encourage you, if you're setting up electronic files, you set up all your folders right away. And as you're getting all those documents, you're putting them into those folders that are relevant for your taxes. And you're doing that all through the year. So once you do that consistently, by January, you're already ready. You have all your information. If you're old school and you still do paper, then you get your 5 folders, right? And just put all those documents and store them gradually, and then maybe get a scanner and scan all those things so that you're ready to send them to your accountant to file your taxes. So that's what I would suggest, to do it as early as you can. Because if you don't do it, then you're just going to be struggling with everybody else in January. So for right now, in April, right? So April is always a crazy time to file tax return because that's when everybody files. But for us as professionals, we know the wait time just gets longer, right? So it's hard to get everybody filed. It's hard to submit all the tax returns in April, particularly for those that are coming late, right? So we end up submitting it in May, right? So some people are a few weeks late. But now is a good time to file because now the wait time is a little bit shorter now because the volume is not as high. So we're able to file for many people right now. And I think that'll still be the situation in first or second week in April.
Okay. Another question, is creating a trust one of your services that you can help people with?
Yes, so we can help with that. So we always work with other tax lawyers to create the trust. So that's not something we would do in-house because we don't do it all the time. It's not something that is required by most of the businesses we work with. But we do have other professionals we work with. So we work with a tax lawyer that we've been working with for several years. So anytime we have to deal with any complex arrangements, even though we may know the answer, we engage a tax consultant because they spend time every day reviewing all the changes that are happening in the tax acts. And so we engage them to get a refresher or to validate some of our own thinking when it comes to that process. So yes, when it comes to trust, we can always help with that.
Right. And one of the things that I learned from Michael Pinnock, another chartered professional accountant, was that you can often, on I guess behalf of the client, the accountant can negotiate with CPA, for instance, if you owe taxes and you may not have the ability to pay, or there's always the ability to negotiate. Is that something that you can do for personal and also business taxes, for instance?
Yes, you can do that. You can do that for both personal and business. So that's not a service we provide, but there are a lot of other providers here that can help you negotiate with CRA in terms of how you can reduce your tax bill. So for us, particularly for our clients, if we have the authority to discuss with CRA on behalf of our clients, oftentimes we can negotiate payment plan with CRA, we can extend deadline, we can do all of those things, but we only do it for clients that we work with, right? So we can have those conversations with CRA about extending deadline, about coming up with a payment plan. Sometimes we do put in documentation for waivers or forgiveness of interest and penalties. Oftentimes CRA will deny them, but sometimes CRA may accept some of them, right? So depending on your situation, it may be worthwhile to just try and see what you can get away with.
Right. So folks, I think that is another good reason to always consult a professional, especially if your taxes are somewhat complex. Obviously, a lot of people do their taxes by themselves, but in the event that you may not know some of the loopholes or may not be up to date with all the different tax laws, consulting a professional would be your best bet. So definitely take that into consideration. Any other questions for Mr. Ken Green this morning? Any other questions? Now, they say there's no time like the present, so come one, come all, ask your questions. Okay.
So, and I've put a couple of links in the chat there. So some information about how to get in touch with me, to join our newsletter, or to get a copy of the book. And if you have any questions, always feel free to reach out. And we'll try to support you as much as we can.
And as they say, there's no such thing in the world as free, but in this case, there is. You can get that free book by Ken Green, and it's an ebook. So click that link and just get acquainted and see what Ken can do for you. And obviously, we always support our professionals within our community. So tell a friend to tell a friend about Ken Green and all the other professionals that we have in our community, in the sense of we build capacity when we use from our own, and we are obviously just as capable and sometimes even more capable than other communities, because sometimes we have to put in twice as much amount of work just to make sure that we're committing and getting the best out of our businesses within our community. So support a Black business today. Okay, if there's no more questions, we're just going to go to Victoria to help us say au revoir or see you later until next week. So we just wanted to say thank you very much to Ken Green for everything that he's brought today, and always a wealth of knowledge. And again, thank you to all of you for joining us here on Community Space, the financial literacy program that speaks the language of the community. So Victoria, take us away, and we'll see you next week. Same time, same place here on Community Space.
Thank you, Roderick. So just coming up next, we have Tuesday, networking with Dwayne Morgan for Level Up, Black Women in Crypto on Wednesday with Stephanie and Emma Todd. And then this following weekend, we have strategic thinking on our next community space. So thank you everyone for joining us today, and you have a wonderful weekend. Thank you.
And we wanted just to thank our partners, RBC, the Donald Reed Estate, and the BBPA for providing this platform. Thank you. Take care. See you later. Peace. Community Spaces, the financial literacy program that speaks and reaches the community. Are we going to be in a better place, or are we going to be still, quote unquote, behind the 8 ball?
Because of the historical disadvantage that our community has, we most times do not have financial role models. Without that, economically and financially speaking, we'll always be at the bottom.
Keep proper books and record, because the data drives the strategy, and the strategy drives the profits.
COVID-19 sort of removed a veil. It's really exposed the structural barriers that our communities face.
These last 2 years, where there's been a heightened emphasis on the well-being of Black people, has influenced the influx of funds and opportunities. The time is now. How long is that window going to be open?
We'll see you next week. And don't forget to tell a friend to join us here on Community Space.